Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Wienerberger. And I looked up how to pronounce the name, and it is pronounced Wienerberger, and I'll try not to laugh, but that is a really funny name, at least coming from the English-speaking world. Okay, let's just get started. So what are they? They are a company that makes bricks, essentially. They're the largest brick producer in the world. They also make ceramic pipes. They make the tiles for roofs, and they make a few other kinds of stuff, but mainly their thing is outward facing bricks and then the actual clay bricks that go into construction in Europe, especially. They're an Austrian company, they're listed in the Austrian Stock Exchange. So, here is sort of their overview. Basically, if you've held this stock at least till from 2010 all the way to 2023, you got a shareholder return of 174%, a compounded average growth rate of 36%. You have something that transformed from being mostly a new build to also including renovations and infrastructure here. So there's some variety here. And even though my camera is blocking it, there's a 99.3% of new products that are designed to be reusable or recyclable. So that's wonderful to see. That's really cool, just in general. So let's look at other things. They essentially operate mostly in Europe, so Europe West and Europe East make about 80% of the revenues, and then North America makes the other 20%. And you can see the revenue breakdown there. You'll see that in 2023, they had a rougher year where everyone started buying a little bit less bricks. And the interesting thing here is everything went down significantly, especially Europe East, for obvious geopolitical reasons. But North America didn't go down nearly as much. The reason why is because there's more construction, there's more housing starts. So that's interesting. Now, if we see the larger picture here, you see a tale that you've seen in other companies so far where 2022 was a year of euphoria and then it sort of normalized. But you still see an overall growing picture, especially compared to 2019. So that's something that we like to see both in revenue, operating EBITDA margin. That's wonderful. And if you look at the latest financial statements, you have basically revenue that decreased, gross profits that decreased, the operating profit decreased by a lot. And this is just important to note. They just had a rougher year all in all. And they even like tempered expectations. They said we went from growing 3.5% in 2022 to 3.1% in 2023-24. So that's something where even they are tempering expectations. They know that construction has slowed down in the Eurozone, especially. And this just reflects all over the balance sheet, even in the profit after tax here, the net income. Everything just reflects here of the slower growth in Europe, the fact that some countries enter technical recessions. I think it's very evident. Now, if we look at the balance sheet, we see overall health. For example, if you look at current liabilities, you have 1.2 billion euros. If you look at current assets, you have 2 billion euros. If you look at everything here, where total assets is 5.46 billion euros, our total liabilities is much less than that. It's about 2.8, 2.9. So you have an overall good picture still. You have an overall healthy looking company. They do have a little bit of goodwill that they'll have to pay down eventually, but at least relative to everything else, it's not like that's a huge portion of their assets, so that's fine. But do note that they do have some cash, but compared to the current liabilities, basically exits it out, so then they're left with a lot of debt that they have to constantly raise money for. So that's something to note as well. And you also just look at free cash flow. Free cash flow went down big time. This is basically because of trade payables. So you can expect it to go up a little bit next year, just because this can be temporary. And if they're getting rid of inventories, that's also good. Something important to know here is that in the non-current assets, or sorry, in the current assets, they have inventories listed as a bunch of this, but does the value of bricks devalue over time? For example, you're a retail company, you and you have inventories of shoes from 2 years ago, you can't get rid of them at the same price. But bricks, on the other hand, you may be able to. Depends on the price, it depends on the demand. But you may be able to get rid of them at a price that is much less of a markdown than something like clothing, right? Or just retail things in general. So something to note about inventories here. But yeah, so cash flow from operations went down. So did capital expenditures, which is this line right here. And in general, you just see a picture of the 2022 euphoria dying down, Eurozone entering into technical recession in some parts. But still, this could be an interesting opportunity if there's a comeback. So you also see that they have a nice little dividend with an 18% compounded average growth rate. And this is nice, but I wouldn't call it the best for dividend investors, and we'll see exactly why. Well, first of all, you also just see that they don't increase it every year. From 22 to 23, they didn't increase it. From 2019 to 2020, they didn't increase it. I personally like it because it shows some fiscal responsibility. It shows that when they know they won't be able to afford something or in tough years, they need that money. So I think it's fine. But if you're solely a dividend investor, you may not love this. Now, I want to do a quantitative model. I'm going to do a discounted free cash flow model. To do that, the first thing I have to do is to calculate the amount of revenue that gets turned into free cash flow. And to do this, I'm just going to compare the numbers from 2019 all the way to 2023. And what we get is an average about 6%. However, last year was rough. What last year was 3.28%. What I'm going to do is I'm going to say next year will be 5%. As I said, it'll probably go up, but I won't make it a 6%. I'll make it a 5%. And the year after that will be 5.5, and then we'll just make it 6% permanently. Okay? So with that, I have a model. So what I'm doing is I'm saying, okay, the revenues won't really grow in 2024 and 2025. I am doing this as a doomsday scenario where maybe the Eurozone just doesn't grow much, and especially Western Europe, and uh, America just has some time to come online for them. Maybe it's growing, but the Eurozone will hold them back a little bit. And then 2026, 27, I'm growing them at 2%, just like in perpetuity. So I'm saying they're going to grow at 2% forever from 26 onwards. Now, I put all these numbers in at an 11% required rate of return. It's 1% more per year than the market has historically returned, which over time, it comes out to be a whole lot of money. So with that, divided by the total number of shares out, I get a fair value of equity of 25 euros and 71 cents. However, if we get out the net debt, then the value post debt will be 13 euros and 56 cents with net debt included. Now, let's look at where Wienerberger stock is right now. Okay, so it's way above those numbers, way, way above. And even if we consider, let's say the balance sheet is healthy, which I do think it is. So maybe we say, okay, we don't really care about this post debt number. We just care about this fair value of equity without the debt included. And that's the 25 euros and 71 cents. Even here, it's significantly overvalued. And you had a buy point here in mid 2023, or no, in late 2023. You had another buy point here in July 22, but that's about it. So you also have a P ratio of 11.21, and I think this is why it's important to look at a quantitative model on top of a P ratio, because if you just said, I'm going to buy below 15, well, first of all, that doesn't quite apply in Europe as it does in the US. But second, it's just not a great reliable method. You would have to look at its P relative to what it's been. So don't just look at the P ratio and say, this is it, I'll buy this. And you also have a dividend of 90 cents, as we said, and a yield of 2.5%. So it's okay, but if it's so overvalued, you'll probably be better off buying it when it's lower, and then the dividend on cost will be much higher then. So all I'm saying is the price just isn't quite there. But if you still want to be an investor in Wienerberger, you have to look at this. It's the number of housing starts, basically, in Europe. So this is looking at the previous year and the next year and the reference year. So, for example, here in Bulgaria, there were 1,528 houses being built, right? Units being built in the year before. In the last year, there are 1,535 units being built. So a little bit more. However, if you look down the list of all these countries, Czech Republic, Denmark, Finland is going up, France is going up slightly, Iceland is going up, but the data is old. Norway's going down. Russia's going down for obvious reasons. Spain is going up. Sweden's going up. Turkey's going up. United Kingdom's going down, which, I mean, if the UK has a housing crisis, that's their own prerogative, but that doesn't seem like a good idea. But the point being, here in Europe, the housing starts are just not growing exponentially. They're not, and in fact, in maybe in the larger economies like the UK or Germany, they're going down. So they depend a lot on this kind of number. In the US as well, you have the Fed that keeps the housing starts data there. And housing starts are picking back up. In the US, there's finally more construction, but at the same time, you want to just take such a good look at that because this is where Wienerberger sales depend. So, because of course, if they sell bricks, if they sell ceramic piping, if they sell roof tiles, they are solely dependent on construction. So Europe's numbers here don't look convincing to me because it doesn't look like any country is ramping up housing starts significantly other than maybe Turkey. So all I'm saying is you have to be looking at this number a lot if you're an investor in Wienerberger and be convinced that this number is also going up. So what's going on? So Wienerberger looks overvalued to me if you considered weak European housing starts plus growth paired with a recent uptick in stock price. North America looks promising. It looks like it's the more highly growth market, but it isn't enough of the revenue right now to justify a high growth rate. Liquidity may also be an issue on the Vienna Stock Exchange, and especially if you buy the ADR, if you buy an American listing of it, you may be able to get in at a price much higher than it actually is and get out at a price much lower than you actually want to get out at. So just be careful with that. And then construction companies like this or cyclical companies like this are best to buy when everybody hates it. So the lesson here is to be a contrarian. I think the stock price here is very high. People may like it because it's gone up, but I would say be a contrarian. Be a little skeptical. If right now everybody loves Wienerberger, then tomorrow everyone will hate it, and that may be a very good point to buy. Now, I thank you so much for watching. I really appreciate it. If you like this video, don't forget to drop a like and drop any sort of comment. I read every comment and I really appreciate it. With that said, thank you so much and have a great rest of your day.